PE ratio is the price to earnings ratio. In simple terms, price to earnings ratio is basically the ratio of the stock price divided by the earnings per share. So if a company had $10 million of net income over the last 12 months, okay, and they had 1 million shares outstanding, okay, that basically would be $10 million in earnings divided by 1 million shares of stock, okay? So that would be basically $10 per share, okay? That's their EPS, or their earnings per share, which would be $10. So if the stock price was 50 and their earnings per share was $10, then their PE ratio would be 50 divided by 10 equals 5. If we just read what this fellow says, high PE ratios suggest investors are expecting higher earnings. Okay. Now, the dangerous thing about a PE ratio is, especially in today's economy, with all the manipulation going on, if a company makes an adjustment that impacts their net income, very easy to do, or what's going on today is with money being at such a cheap interest rate, companies are buying back their stock. So let's say that company had $10 million in net income, and then they ended up buying back half their shares. So they bought back, instead of 1 million shares, they bought back half of those, and now they have 500,000 shares. You basically, instead of being 10 divided by 1, it's 10 divided by 0.5. You just increased your earnings per share from 10 up to 20, which the reason they do that is to boost their stock price. And why would they care about that? Well, obviously, stock price makes a lot of people money, but also a majority of corporations reward their executives through stock compensations. And so by increasing the earnings per share and increasing the stock price, it triggers those bonuses for these guys. And in essence, they make a lot of money. So if we look at one of, well, it probably is the largest corporation on the stock market now, Apple, and you'll see that in the last year, their stock price has gone up approximately 50%. In fact, it's right here. It's plus, over the last 52 weeks, it's up almost 70%. That's incredible. Now, their PE ratio, if we go to key statistics, you'll see that their PE ratio for the trailing 12 months is 17. The 5-year average is 14. Okay, so, and then their industry is right around 17. And you'll see the market cap. Now, if we just wanted to quickly determine approximately how many shares outstanding there were to do this calculation, the market cap right here is basically the stock price, $125, times the number of outstanding shares. So if we took 741 billion divided by $125, it would come out to a roughly 6 billion outstanding shares. So if Apple bought back 1 billion shares, or they adjusted their net income, it would change this PE ratio. Now, a PE ratio is really best used when comparing the same company, because if you see over time that it's changed, if this number increases, so if the stock price increases, let's say it went to $250, well, their earnings over the last year hasn't changed, so that would double their PE ratio up to 34. So that would tell you that somebody somewhere has information that makes them believe that their net income is going to double or increase significantly. Now a PE ratio, that's 17. Basically what it means is you were willing to pay for a share of Apple stock $17 for $1 of their net income. Paying $30 is more than paying 17, obviously. And so there has to be a reason why you would pay more. But what could happen is, if we go over to lumber liquidators here, okay, lumber liquidators was flying high. Okay, you can see a year ago their stock price was over $100, and then that news story came out that they were having basically quality issues, and look at what happened. It dropped basically from 75 down to $30. And in last year, it's down 75%. So if we add up these 4 quarters right here, so the last 12 months, it was an earnings per share of $2.31. So if this stock was at $75, okay, so their stock price is at $75 divided by 231, that's a PE ratio of 32. Now I know it's different industries, but just based on this, Apple's at 17 and Lumber Liquidators at 32, because this is saying you're willing to pay $32 for $1 of earnings. So there had better be a good reason why you want to do that. Here's another one that's, I think, absolutely ridiculous. Netflix